Well, I want to thank everyone for joining us today for Investor Power Hour. I'm very excited to share this time with Dexter Campbell from our team, and we're going to learn a little bit more about how institutions underwrite deals and how they look at them. And Dexter, could you tell us a little bit about your background and some of your experience?
Sure, Chris, I appreciate it. So I've been in the real estate space for about 20 plus years. Originally, I was in the real estate debt side for probably, instead of 2 years, working at what is now, I guess, Brocadia. I also spent some time with GE Capital on the acquisition side, doing large scale business development deals, transactions for GE's balance sheet. And then, sort of coming out of the GFC, I spent more time at numerous shops being responsible for capital formation. So as you think about deals, I was the guy who was going out and interfacing with LP equity to raise capital to do large scale acquisitions or development deals throughout the United States.
Okay, thank you for that. And I'm gonna just jump right in, and naturally there has been a big change in underwriting and how deals are looked at just due to interest rates going up and a lot of the things that have happened. And I'm getting an echo. Let me try something.
Oops. Yeah, we're still getting feedback.
Okay, testing. Okay, now back to my question. I'm still getting an echo. Is it something on your end or?
No, I'm still getting feedback as well.
All right, let's, I guess, just continue. How has underwriting or institutional underwriting and the criteria evolved over the last few years, given a lot of the changes that have happened in the market?
Yeah, I think the big thing that we're seeing as it relates to institutional equity is they're being a lot more conservative with their underwriting given everything that's happened. So a lot more time is being spent sort of fact testing, if you will, the assumptions. Do do we believe in the rent growth? Do we believe in the cap rate compression in many cases? A lot of institutional investors are now spending time really trying to make sure that they believe in that information. So they're asking a lot more questions. They're wanting to make sure that the sponsor has also really vetted all of the assumptions that go into the model, because ultimately that is the business plan. And if any of those assumptions are off, that's going to derail the expected future cash flows and ultimately the returns of the deal. So there's a lot more focus based on the assumptions because you really want to be more defensive today than you have been in the past.
Sure. And what's some disconnects that you have seen from where sponsors are looking at deals and where some of your institutional investors are looking at? There's I know a bit of a disconnect from an acquisition perspective, but what's happening as I guess essentially in the capital markets?
Yeah, I think there's a lot, right? It kind of runs the gamut. Hey, is that price really the right price based on a lot of different factors? So thinking about things like what's the value versus replacement cost, that's one thing that sort of jumps out. Another big thing is again, sort of what are we really assuming is going to happen as it relates to the model, and also um, when we kind of really own the asset, what can we expect? So you don't want to show rent assumptions that are above market. You don't want to show certain things like if we were to implement a capex plan, you don't want to assume ROIs on that plan that are overly aggressive. So again, it's really coming down to understanding the assumptions, making sure that you can prove things out, and making sure that things are aligned with a market standard. I think a lot of times sponsors tend to be a little bit overly optimistic. The institutional partner wants you to kind of scale back those assumptions and really be thoughtful, really be careful, and plan for the downside. So what happens if rents don't materialize at a certain level? What happens if again rates continue to rise? Are you really protecting the capital the right way? So building in all the right assumptions and building all the right protective mechanisms is going to be important when interfacing with capital.
Okay, I appreciate that. And what are some of the top checked or boxes that need to be checked for institutions to eventually invest into a deal?
I think it comes back to, is your capital going to be aligned with mine? So one of the first things that people want to look at is, um, do you have skin in the game? They a lot of times institutional equity wants to see money at risk from the GP. So the GP has to have a real alignment, some real capital that can be again investing alongside the LP capital. What are the underlying assumptions as relates to leverage? Hey, is there too much leverage? Are we using floating rate debt? Are we using preferred equity? Is the structure overly levered? Because obviously leverage can drive returns. So we want to almost look at a deal with a more conservative leverage plan, such that we're not sort of financially engineering something. Um, Again, looking at the headline assumptions, the rent assumptions, the expenses, the exit cap, what are we assuming? Are things kind of in line with the market standard? Those are some of the headline things that groups tend to look at when thinking about making an investment decision with a particular sponsor.
And what potential red flags may come up during a process where an institution will give you a fast rejection on a deal?
Yeah, I think it's sometimes just being overly optimistic. Let's not assume the upside is the base case. So you don't want to go into a situation again where assumptions are not commercially sound. For example, I'm making this up. A rent growth assumption of 5% per year, right? That probably feels a bit too aggressive, especially when the market is producing 2 to 3. Have you thought about things the right way as it relates to, let's say, insurance? Because a lot of times people are not thinking about those line items, but insurance seems to be something that is coming up in a lot of conversations. So making sure you underwrite those OPEX and those line items correctly, so that if something goes off plan, is the investor capital really protected? So it's really, again, just understanding those headline assumptions, not going too crazy, and again showing by comp data, by having evidence in place that these things can be achieved. Those are the most important thing, because again, if the assumptions are not in line appropriately, it's going to definitely be a concern to that outside investor who's looking at doing your deal. And also, in many cases, you're speaking to a group for the first time, so you want to make sure that you're really being thoughtful and smart about what you're putting in front of them.
And across your career, you've raised capital from large institutions, family offices, RIAs. What differences do they have, in how they look at deals, or is it just kind of the same, or are there any distinct differences between the different groups?
There's some differences, but there's also quite a bit of overlap. I would say the main things that are the same are, no matter who you are, the team, the theme, and the track record are the first things that any investor is going to take a look at. So they want to make sure that this team understands the sector really well, and they have a track record performing in said sector. So obviously, we're in the value add multifamily space. We have a team that's been doing only value add multifamily for a number of years, pretty much since the inception of the company. So we have the right team, right? We also have the track record of performance. So we've been able to go out and do deals, have the deals go full cycle, and deliver outsized returns to investors. So the track record's in place, right? So again, team and the track record there. And also, what about the theme? We all know that there's a housing shortage. We all know that multifamily has been pretty resilient. So as a sector, I think that also, that checks that box from a theme perspective. So that's fundamental, right? Everyone's going to look at theme, and track record. But then where you have differences from RIAs to family offices, institutions, is pretty much as follows. Family offices are going to want to make sure that we can be responsive, and they want to make sure that the team in place is one that they feel they can trust. So relationship building, the people aspect, that's going to be extremely important to a family office, because you're ultimately speaking directly with the end user. And what I mean by that is it's our sponsor talking to the equity directly in many cases from a family office perspective. If you think about RIAs are a bit different in that they're going to look at how does this investment idea or thesis fit within one's overall asset allocation. So RIAs are investing or thinking about deals on behalf of their clients. So how does this multifamily strategy fit within one's hedge fund or equity book or whatever else that they may have? Oftentimes for us, where our product is going to be unique or idiosyncratic is we're going to provide cash flow. We're going to provide a tax advantage strategy. So that tends to look really well in an RIA's client's portfolio for those reasons. When you think about institutional capital, you may be dealing with a lot more tax exempt, for example, and larger scale investors. So they're going to be more sensitive to things like reporting, compliance. Do you have a tax team, a legal team, a risk team in place? What do you do from an ESG perspective? So there's a lot more boxes to check institutionally because I think they have to also they being the institutions they have to be able to understand and check more boxes for their committees to sign off on what we're doing. So I think again there's a decent overlap in terms of the basics, but there are some differences as you kind of think about each group because they have sort of different constituencies, and you also have different end users who are ultimately putting that capital to work.
And based on your experience, how much of institutional underwriting is qualitative versus quantitative?
It's hard to put percentages around it, but certainly the quant kind of gets you in the door. So certainly, delivering what I would call an outsized return with measured risk is going to resonate initially so that's the quant, right? And then we talked about the qualitative before, making sure we have the right team, theme, track record, and then also sort of the supporting functions in place so that the boxes are checked. So they both matter. The percentages are hard to sort of quantify or describe, but I think I would say the minimum is 50-50, probably 60-40 in some direction.
And naturally, what we do, we look at a lot of deals, and there's some deals that I love and am bullish on, and once you get into the numbers, they sometimes don't work out, and there's the other deals that on the first look I don't necessarily like, and they end up going great on paper. Would you be able to share an example in your experience of raising with institutions, a deal that worked out great on paper, but the institutions just did not like it and were not able to raise capital or issue capital
There's so many things to think about. I would say this. So I joined Disrupt, within the last 3 months. So call it 3 months ago, I joined the firm. But before being with Disrupt, I was with another sponsor, and we were trying to do a large scale recap. And the numbers of the deals seemed pretty compelling at first, but once we started looking at more recent cash flows and recent performance, things did not seem as attractive anymore because we got new data. And that data also became a little bit more scrutinized for a lot of different reasons. So that was one deal that quickly fell by the wayside because as we refreshed the information, things were going sideways, and that was not a good outcome for the sponsor that we. I'm sorry, that was not a good outcome for the investor that we were talking to. There's other cases where we've looked at deals, or I've looked at deals, and I've been challenged on the exit assumptions, or been challenged on the refi assumptions. So while things may look good initially, that a lot of the return was based on the exit playing out a certain way. So maybe there was not enough cash flow, and maybe the deal was more reliant on the end of the ultimate execution. And given that there was so much reliance on that execution towards the back end, people said, hey, you know what? I don't want to be solely reliant on that final outcome. I much prefer to have income being delivered along the way with some of the return being captured, on the back end. So those are situations sometimes where deals may look good, but where's the risk and the return really happening? Is a lot of the return happening in year 5, or is it sort of being distributed, years 1 through 5 with a portion then being paid on the back end? So I would say those are things that oftentimes concern people, because one of the best ways to achieve or to raise capital is to de-risk the deal as you go. And I think one of the best ways to do that is to produce durable income where people can feel like they're getting paid. And then again, having some of that residual risk being absolved or being paid for, or being not being paid for, but not being as reliant on that residual risk or that residual outcome.
And you touched on something about essentially new information, and naturally, given the state of the market that we're in right now, interest rates have ticked up recently, and there is a bit of market volatility. And how does the current state of the market change what institutional underwriters care most about? I know you kind of touched on cash flow. I would assume that's important, but could you kind of expand on that?
Yeah, I think in a market where you have volatility, you would definitely want to be using less leverage or more fixed rate leverage. So things like that, that's right out the gate, something that you can use to kind of mitigate some of those concerns. If we believe that rates are going to be higher for longer, and if we also think that there may be situations where, um, you know, sorry, Chris, did you lose me? Sorry, I apologize. Let me just, my computer kind of tricked out for a second. No, I was just saying though, you want to be less reliant on high leverage, and you also want to be less reliant on, call it, floating rate debt. Because a lot of times, if you think about things like bridge debt, it's typically 3 years, 3 years of term, 2 1 year extensions. You're really putting a lot of pressure on the business plan. If the business plan has a hiccup in years 1, 2, or 3, um, and now you're looking to refi in year 3, or some at some point towards the back end of that duration, you're putting a lot of pressure on the execution. So to the extent that we could use lower leverage and or fixed rate debt, that's a better outcome, and that's a way that one can sort of get ahead of that kind of volatility or those kind of concerns. So I would say definitely prudent use of leverage is always going to matter. Not being reliant on financial engineering, whether it's bridge debt or even preferred, which kind of sits behind that first mortgage, and that oftentimes that you can use preferred to kind of go up to a higher leverage level. That's going to, in theory, provide a better return. But to the extent that you don't have to utilize those types of outcomes, that's a good thing. Also, more sponsor equity tends to, again, soften the pain and gives you a situation for.
Hey, Dexter, I lost you. I can't hear you. I can't hear
Did you lose me?
you. Okay, yeah, I did lose you. Now I can hear you.
You lost me.
Oh, now you're back. I just heard you. Can you?
I was just saying, again, prudent use of leverage and not putting too much floating rate debt on the deal is something that works out really well, oftentimes, or that's better received by capital.
Okay. And the last question that I have before we go to the audience for questions, for the potential sponsors that are watching today, what would be, I guess, your biggest, piece of advice or most impactful thing that they can do to improve in their underwriting process before they start pitching to institutions?
I think it's really asking a lot of questions amongst themselves, making sure that if everything is really vetted, and by that I mean making sure that you have great comp data as it relates to rents, making sure that you have great data as it relates to exit assumptions, so sales comps, and really scrubbing every line item, being really smart about your operating experience or your operating expenses, and leveraging what you have internally. I think one of the good things about us is we have quite a bit of assets in certain submarkets and markets. Oftentimes, we can look at some of our portfolio and say, hey, here's what we think is the right sort of operating margin for this sort of asset. Here's what we think we can achieve from a um, from a rent growth perspective. So I think it comes back to really looking at information, utilizing the right way, asking as many questions to the market and also internally, so that when you ultimately put a deal in front of pick a name investor, you've put something that has really been vetted and you get ahead of their questions. I think the more you can get ahead or anticipate the questions that you're going to be asked, the better it is, the better it's going to be as it relates to having that in-depth conversation. If you think about it like this as well, we're basically asking people to trust us with large sums of capital, whether it's a retail investor or an institutional investor. So we want to make sure that we can provide the answers in a thoughtful, seamless fashion so that they can basically derive the appropriate level of confidence because we're going to be stewards of this capital for at least 3 years, if not longer. So that's kind of how I think about it. It's really just drilling down and asking as many questions and getting all the evidence in place so that we can put ourselves in a position to really be the right fiduciaries and create that kind of trust.
Okay. And thank you, very much for your questions. I do want to open it up to the crowd to see if we have any questions for Dexter or myself. If you all do have questions, feel free to type it into the Q&A at the bottom, and I'll be happy to get those answered for you.
Chris, I lost your audio.
Um, can you hear me now?
Yes.
Okay. We just had a question if we can, investors can come off a mute. Unfortunately, I don't have the ability to do that, but you can, type it into the chat and we can answer it. Does anyone else have any questions? All right. Well, no, I want to thank everyone for joining. Here it comes. Here we go. Okay. So we have a question. What are your most successful methods of reaching out to institutions? Is it through cold calling? Is it through relationships? How do you start?
I think code calling is hard just because investors get a lot of people just calling them randomly. So I tend to always revert to people I know or people that can introduce me to potential investors. So I think that brings credibility, that brings trust, and that brings a more efficient way of getting their attention. I'm sure, again, capital partners or prospective capital partners get a lot of sort of outreach, and I think that's inefficient, especially given that a lot of deals we have to move somewhat quickly. So we want to make sure that we can effectuate that interaction a lot quicker and a lot more efficiently.
Okay. And, to add, because I have seen you do this very often, I I have seen you invite people out to lunch all the time, and I think meeting face to face and getting in front of people does go a long way versus exchanging emails or potentially cold calling and that type of thing.
Yeah, one thing I realized is everyone's got to eat at some point. So I think a lot of times that lunch or that dinner or that sort of that coffee, whatever it is, allows you to kind of have somebody sit down with you in a more relaxed setting. It doesn't always have to be deal first. I think it's more about let's create a human connection, and when the time is right, hopefully we can work together as partners in a transaction. But I think it's all about creating trust, creating partnership, creating relationship, and getting someone to believe that you are again the right partner for their capital, and kind of going from there.
Okay. And one other question. When evaluating deals, how much of an emphasis or focus should institutions or do institutions place on fees? What fees and the quantity of fees is standard for institutions?
Fees are a thing that oftentimes do get negotiated. I think what's customary with larger scale institutions is they are comfortable typically paying. I'm going to say at the sort of the deal level, they are comfortable paying an asset management fee. They're comfortable paying some sort of performance fee. Things like acquisition fees tend to be negotiated. What I mean by that is if we brought a deal that was off market, an acquisition fee, it tends to be appropriate. A broadly marketed deal, getting an acquisition fee tends to be sometimes debated because it's marketed. But if it's off market, you can definitely charge an acquisition fee. But certainly promote and asset management fees are and an equity management fee, if you will. Those are a bit more customary when talking to institutions. So they are very comfortable paying those if they feel that they're getting a unique, again, an idiosyncratic deal that can deliver outsized returns. Um, that's normal.
Okay. And do institutions ask for audited financials of a developer for a new build, or do they, I guess, care more so about what the deal is?
It depends. Some will ask for audited financials. They may say you have to use a Big Four accounting firm, depending on the size of that organization. Others may be more reliant or less reliant on that sort of situation, but it really depends. You got to think of it like this too. I'll just give you a quick example of something. I had done a deal a number of years ago. It was a development or sort of a adaptive reuse deal in Charlotte, and we brought in a client or investor that had Yale endowment as one of their investors. And Yale had a certain sort of requirement as related to financials and that sort of thing. So we had to be a little bit more thoughtful in terms of how that reporting was going to go, because ultimately the investor was Shorenstein, and one of Shorenstein's investors was Yale, just for what it's worth. But the point is, Shorenstein had an accounting standard, a reporting standard that they had to achieve, so that Yale felt comfortable. So it really runs the gamut. It depends on who the end user is how I think about it. And to the extent that it's an endowment or an insurance company or institution of some sort, they may have certain standards that require a certain level of accounting standard so that they can be comfortable. But again, it runs the gamut.
Sure. And to touch back on fees, how do institutions look at it? Is the expectation that fees are kind of front loaded at the front, or are they ongoing throughout the deal? Can you talk about that a little bit?
Um, sure. So I would say an asset management fee tends to be a an ongoing fee, what I would call a fee that's on the run. So every year, we, the sponsor, can capture an asset management fee. The promote, which we can argue is a fee depending how you think about it, but that's a performance fee. That's a back end fee. And depending on if you have a fund construct, you can charge a management fee typically on the equity invested. So those are sort of the main fees. And then we talked about the acquisition fee. If you get an acquisition fee, that oftentimes tends to be more of an upfront fee. So whatever the number is, 1 or 2%, that can be captured upfront. But some again, these most of these things, I mean, that's sort of the market standard, but there could be some negotiating along the way, both from a size perspective and also a timing perspective. But clearly, to promote that fee that we would receive, that's typically based on some sort of capital event, oftentimes a sale, but that could be captured also if you crystallize or have a refinancing of scale. You can tend to see something there as well.
Okay. I appreciate that. And just wanted to see if anyone else has some questions. Feel free to type it in that Q&A box. Well, I want to thank you for joining me, Dexter, and thank everyone else for joining. I personally learned a lot, and I hope this was value to everyone. If anyone does have questions for Dexter or myself, feel free to email invest@disruptequity.com, and we'll be happy to answer it. And now we will have this again next month, and am looking forward to it. Thank everyone for joining, and see you all soon.
Take care, guys. Thank you.